are in listen-only mode.
Hello everyone, and welcome to today's webinar brought to you by BillingTree, as they will be sharing some great insights and results from their auto finance business strategy and technology survey that has been orchestrated and has some great results and some interesting findings that will be beneficial to operations of all sizes. I'm Nick Zulovich, and I'm the editor of Subprime Auto Finance News, and wanted to welcome you again to today's session. We have a great lineup of panelists who are part of today's event, beginning with one of the orchestrators of the survey. She's Maria Lang. She's the Director of Strategic Alliances and the Auto Finance Division at BillingTree, and she'll be going through parts of the survey that are most relevant to your business, as well as some other key findings. We also have two executives who, like you, are in the trenches day in and day out in the auto finance business. First is Amber LeBeau. She's heads up accounting and special projects for Security Auto Loans, a firm near the Twin Cities market in Minnesota, as well as Tyler Smith. He's the Director of Compliance for AFS Acceptance, another subprime auto finance company based in Fort Lauderdale, Florida. So we welcome you to today's session, where we'll be going through BillingTree's survey, and to go through those key points, I'd like to bring in Maria Lang into the conversation. Maria?
Thanks so much, Nick. I appreciate it. I will clarify that my name is actually Maria, but I know how difficult it is, so I'm used to that. We just wanted to start with a little legal disclaimer. So just want to make sure that everyone knows that they shouldn't construe anything that we say today as legal advice of any kind. So easy enough. We can move along. We do plan to have an interactive session today. Obviously, we have panelists, and we're not going to just bore you with PowerPoint. So we encourage you to ask questions throughout the presentation by using the GoToWebinar question panel, which should be on the little floating panel that is on your screen to the right. In addition to that, we will be having some interactive polls that we will launch during the session while we're speaking, and then we'll kind of review the results of those polls to see if those topics are something of greater interest to dive into while we go along today. The plan for today is that we will be covering a survey that BillingTree conducted of auto finance companies over a one-month period in March of this year. And as you can see on the screen, we had a lot of different sized companies that answered the survey. And so you can see that it was taken by professionals from organizations from a very small to very large. And we thank our survey takers for taking the time and giving the feedback, so that others might benefit from the benchmarking that they might get from the survey results. If you advance to the next slide, Nick, today we're just going to be covering 4 key topics from the survey. The survey was about 17 questions in all, so there is some additional information that is in the survey report, which is available, and I believe that you will be given a link to obtain the survey results. Everything is complimentary. We are not charging for this at all. And today we plan to cover these 4 key points: cost reduction in the regulatory burden, convenience fees, payment acceptance, and communications with borrowers. So let's jump right into the cost reduction and regulatory burden. In this section, we'll explore 2 key questions that address the overall concerns for growth and profitability for the survey takers. You can see that the survey revealed that top-line performance is a very close second to cost reduction strategy as a bottom-line performance. And the cost reduction strategies appear to have won out because a significant number of respondents ranked this a number 10 on a scale of 1 to 10, showing that this is extremely important for most of the respondents. So one of the survey questions in the recent survey by the National Auto Finance Association showed that while most articles and statistics have cited auto sales and the financing industry on the upswing, many companies are still struggling with profitability. And in fact, despite in the subprime market that the NAF surveyed, despite a 7% decline in operating expenses, profitability had declined by a larger 10%. So I'll start with you, Nick. What do you think are some of the reasons for that finding?
I think it's definitely it's the case where the compliance burden is growing significantly, especially since the Dodd-Frank Act came into being, that the Wall Street Reform Act coming out of the recession, and a couple of other studies that have come out to clarify just the amount of regulatory burden that's been put on the entire industry nowadays. Back in May, NADA commissioned the Center for Automotive Research to orchestrate a study, and that firm found that franchise dealers on the dealer side spent $3.2 billion in 2012 to remain compliant with 61 different federal rules. Now, that wasn't completely associated with the financing of vehicle transactions, but that was a significant portion of it. So on the dealer end, they are certainly feeling the pinch, working with customers face to face in the vehicle finance transaction. And then just something I spotted just in fact today. The American Action Forum, a nonprofit think tank up in Washington, D.C., their research has found that the implications of the Dodd-Frank Act and other regulatory burdens have resulted in $21.8 billion in costs. Now, that's across the entire financial spectrum, including mortgages, credit cards throughout, but certainly auto finance is included in that space. And another little tidbit that the American Action Forum's research had found that regulators have yet to implement more than 25% of the Dodd-Frank Act. So only a quarter of what that piece of legislation has been designed to regulate has been implemented. So that tells me that the regulatory and compliance burden that finance companies and commercial banks and any firm associated with any type of credit transaction, that the burden that they already face is definitely going to be increased and intensified going forward. So that's just a couple pieces of survey data to go along with, and that is congruent with what BillingTree's survey showed as well.
Yeah, I think that's true. Tyler, what can you tell me about your experience at AFS Acceptance? And I think you had a story for us the other day that your current position as Director of Compliance says a lot about what it takes to operate in this environment and lower risks and possibly controlling long-term costs that way.
Yeah, thanks, Maria, and hello, everyone. Yeah, the story that I mentioned was I've recently taken over the role of Director of Compliance, and we're a company who in the past has never had someone solely dedicated as a full-time position to compliance. We've been growing significantly over the last several years, but it's always been something that was sort of a side job for someone or was shared among several people, and we made the decision to actually hire someone to replace me in running servicing, which is what I did previously, in order for me to take over this role full-time. So, you know, the cost there in terms of having to bring someone in to fill my old position so we could create this new position is big in itself, but then when you look at all of the things that we've had to do to review our processes, to review our state-required notices, to review our fee processes, all those things cost money, and every time we have to reach out to an attorney to review different things, again, it just continues to add up. So it's been a big cost for us, which obviously affects profitability.
Yeah, that's true. And I just want to mention I just launched the first poll, and we're starting to get the results, which I don't think anybody will be too surprised. There's no one in the disagree categories so far. Amber, what about at security auto loans? How do you handle compliance? Given that you are, you're operating in a number of states, but I think you're a little bit smaller organization than AFS Acceptance is.
We have implemented a compliance officer. She's working currently part-time to 3/4 time. She's also our collections training officer. So she's doing both jobs right now, but planning on moving her more into compliance as we get the collections department fully staffed. Another thing that we did was we realized that in order to be compliant in accepting our payments via credit card and check by phone or ACH over the phone or via websites, we moved to have a third-party vendor take care of all of that and no longer accept payments in our office of that nature. So basically what we did was and not to advertise BillingTree, but they're a great company, worked with BillingTree to set up a website where the customers would go on and enter in all of their own payment information so that our customer service reps were no longer seeing the credit card numbers or the checking account numbers, because the amount of paperwork follow-up and the amount of follow-up to remain compliant was just too much for our small company to handle. So yeah, that was one of the, oh, go ahead, I'm sorry.
Well, I didn't want to lead the witness too much, but I also remember that there were a number of programming things that we did because you wanted to make sure that some of your business rules were enforced as well. Can you give some examples about that?
Oh, there's a number of customers that we would prefer not be able to make payments online or via the telephone, that we'd rather them call into our office in order to speak with one of our customer service reps. Anyone who does collections on the auto financing side would know that you kind of want to talk to the person that's 60 days delinquent. You appreciate the fact that they're making the payment, but you kind of want to see what's going on and make some more payment arrangements. So we limited things like that so that people they would have to call in first, and then we've since set up different options that once they've been on the telephone with us, we could transfer them back to the IVR and allowed them to make the payment, the IVR being the telephone integrated voice response, so that they can make their payment, but that they have to follow up with us first or call us first and then are allowed to make the payment, if that makes sense.
Yeah.
I feel like I'm rambling. Sorry.
So let me just mention that the poll results, and thank you to the person who asked the question. They said, isn't non-compliance the risk, not compliance? And you're right. I mean, maybe from a phraseology standpoint, it is more correct to say that non-compliance is the risk. But I think it's just the whole area of compliance. Just it becomes the cost. The cost of making sure that you are complying, I think, is what we're talking about here, and the risk of not doing that. So in any case, the results of the poll were that 48% strongly agreed, and an additional 36% agreed that compliance is a significant risk in their business. So I think, I'm not sure if that would be something that would change year over year, since this is our first annual survey. I mean, I imagine that the environment in auto finance right now is that's heavily the topic of in every conference. But perhaps when we do a survey again next year, maybe we'll see a change, and hopefully we'll see that number decreasing. Nick, if you go to the next slide. similar question. In this case, we asked about operational concerns, and here, maybe this question mixed with the last one is kind of shows the overall mindset in the industry. But if you notice that, cost reduction is still a very high number, coming in third, with increased operating expenses being a significant operational concern. But compliance policy, procedures implementation, CFPB and UDAP regulation and audit, these are all, top concerns in the industry. And what, have they been an issue, has this been an issue in terms of the growth of your company? Amber, for example, what's Security Auto's experience been in terms of growth and profitability? Have you been seeing an uptick?
We have not been seeing an uptick. We haven't grown or been as profitable as we would like to. So we started to move, looking at different options on how to increase our profitability. One of the things that we moved to was we looked for a different option. Again, this is for our online payments, our credit card payments this time, trying to get away from having to pay the fees directly to the credit card company. So what we've done is, with BillingTree's help, we charge our, and that's probably the wrong way to say it, but our third-party processor charges the customers the fee for using, or for the ability to use the online or IVR capabilities, and we are then not charged any kind of merchant processing fee because that's taken care of by the fees. So that's helped improve our profitability. We're not quite where we want to be yet, but it's improved it.
What do you think has been the biggest factor that has affected the lack of growth? Are you finding, I think you mentioned when we spoke the other day, you mentioned that you've had some greater competition.
Yeah, I think that other bigger finance companies have started to move into the subprime market, which is our niche, and it has been for the past 10 years. And we think that just bigger companies are working on moving into that area and offering more than we can offer. Mm-hmm. So that's part of the reason that we think that we're not as profitable. So,
are you finding the same, Tyler? Are you finding the loosening of the credit market is causing more companies to go further downstream?
Yeah, I mean, I think that's definitely true. As I mentioned, we've been growing actually pretty rapidly. We've more than tripled the portfolio in the last couple of years, but we've also had the same experience that profitability isn't quite where we want it to be, for all of the reasons that we've talked about. And so the cost-cutting measures, or the trying to figure out how we can be more efficient, are on the top of our list. And we did something similar to what Security did, in that we have our third-party processor that handles all of our payments. They charge that fee directly, so we don't have any involvement in it at all. And that was all part of the compliance risk as well.
So I have a question from the audience, and the question is, why is loan performance or loan loss not on your list of concerns, or is that covered later? And I have to admit, it's just not on our list of concerns because it wasn't something we thought of when we designed the survey. So we will definitely add it for next year's survey. But maybe, Tyler, can you speak about that?
Yeah, for sure. I mean, I think that everyone is experiencing that things are loosening up. And so loan loss definitely is, I think, on every company's top of mind. And it definitely affects profitability. As we all know, as things loosen, you tend to experience a little bit of an uptick in losses, and that's what a lot of things are showing out there, and I think that that's just a natural byproduct of the loosening of the markets, but it definitely should be something that people are concerned about.
Okay. Tyler, I think when we kind of discussed this session, you had mentioned, going back to the question of compliance, and I'm just going to launch another poll here. You had discussed that you were putting some compliance management systems in place, and a lot of times this means actual systems, but sometimes it just means in terms of software, but sometimes it just means new procedures. Can you talk about what you've been doing at AFS? And obviously, we had an announcement in Subprime News just this morning about a new staff member that you have now a vice president of risk management. So again, can you kind of talk about what have you been doing to formalize your compliance program?
So we've actually, you mentioned software. We are using a third party in order for us to get the complaint tracking software system up in place, and also to help kind of bring our compliance management system together. So for example, a place where we can store all of our policies and we can keep track within that system when they're updated and what was changed and who changed it. And it also puts permissions as to who can change things. It's in process because we, like everybody else, I think are trying to be proactive and get these things in place, but it takes a lot of resources and a lot of time, and it's going to be a lengthy process to get everything there, right? So in the process, we're also reviewing policies and determining where changes need to be made, doing annual reviews of, like I mentioned earlier, compliance letters, state-required notices, things of that sort. But yeah, that's one of my biggest tasks in moving into this position is to get all of those things going and running on all 4 cylinders. So.
Okay. And so we've got the poll going here. I want to just mention, and I'm trying not to make a shameless plug here, but BillingTree has a number of completely complementary resources available in the compliance space. For one thing, we have a number of partners. We deal a lot with collection agencies as our clients. So compliance has been a long-standing issue for BillingTree and our high-risk clientele. And we have a number of partners who offer compliance management systems and complaint tracking systems with workflow and all the things that Tyler mentioned. And they're all very low cost. So if you'd like a referral to any of those companies, we'd be happy to provide that. In addition to that, BillingTree maintains a library of compliance materials on topics like Regulation E and payment compliance, how to make your credit card program, debit card program more compliant or less subject to visa guidelines or shutdown. So we'd be happy to share all of that material with you. So let me share the results of this. It looks like from the standpoint of compliance management systems, most companies are not doing a formal compliance management system. And I think a lot of companies are smaller than the CFPB has targeted, but again, I think Tyler, you mentioned that your company has taken the attitude that perhaps even though you're not considered a large market participant, you might just be preparing as if you were.
Yeah, I mean, and it's worth noting. I see all of the state audits that come in, and I saw one just today that actually one of the questions was that they wanted any complaint information that we had for during the examination period. So, and I believe the examination period was for part of 2012 and into 2013. So, even though this is just coming about and there's a recognition that companies are going to be chasing a little bit to get all these things in place, they are starting to ask for these things even on the state audit level.
Okay, yeah. Let's see, we've got a few questions. I'm trying to scroll through them and they're kind of hard to see. Let's see. So one of the questions was, who do you see as the new entrants into this market? Maybe you addressed that, and Amber and Tyler, did you feel like the companies that are entering your market as competitors are new, or are they just existing, maybe auto finance companies that have been dealing historically in just the prime market?
At least from what we've talked about in my office is that it is the companies that have previously existed in the prime market that have, just decided to go into a different direction or try their hand in the subprime, in addition to continuing with the prime market.
Yeah, I think we have a question actually in the survey results that would corroborate with that. That a large portion of the survey respondents, I think it was close to 50%, mentioned that they deal with the entire spectrum, so lending from prime all the way down to deep subprime. So that was one of the surprising things that we did find from the survey results, and I think from a validity standpoint, since we did have a wide spectrum of companies of all different sizes answering the report, it seems to be pretty statistically valid. So let's shift topics again here. There was actually a question from the audience when you were talking about this, that is it a general trend to pass the credit or debit card processing fee toward the customer? I think if we go to the next slide, you will see that, yes, it is. From this chart from our survey, you can see that about 68% of the market is charging convenience fees to offset costs and possibly operate that as a profit center. So Nick, what do you think about this? And have you had some articles about convenience fees?
I think this is definitely a part of the compliance pie that's the industry has the opportunity to explain using kind of the general state of our economy and how transactions are made nowadays, that this fee is necessary to ensure that the customer's information and accounts remain secure. Most people have heard about the turmoil that occurred over the holiday shopping season when Target, the big box retailers, systems were hacked and compromised. So perhaps this is a way for finance companies in the auto space to explain to their customers that yes, this is a necessary fee, but the benefits that you get from it is the convenience of being able to make your monthly payments through a various methods, and then at the same time that it's ensuring that your account and your personal information remain secure in an environment where there's individuals who are unscrupulous and would want to compromise people's information. So it can be presented in a way that while there's a benefit to it, there is a cost that is incurred, but it's to the benefit of the customer.
Yeah, I think I would agree, and from a credit card processing company's standpoint, the kind of the gold standard is PCI compliance, payment card industry compliance, and there are 4 levels of that, and your processor should be a level 1 compliant processor, and really should take an active role in advising you on how to make your office more compliant, because while your processor might be compliant, you might be doing some things in your office that are not compliant. Not that Security Auto was doing anything wrong, but one of the things that we are implementing with them is to do an agent-assisted IVR system, so that if one of the Security Auto agents or collectors is speaking to a consumer, they can transfer the consumer into an interactive voice response system and let that automated system collect the credit card information or the bank account information, so that none of that is ever heard by the agent. Amber, can you talk about what that means to your company, and does that help you sleep at night, I guess?
Well, it does definitely help us increase payments received in the office, and so that does help us sleep, and it also, with security, that helps us sleep as well. So yes, the reason that we implemented that was once again going back to the rules and regulations that we set up when we set up our IVRs, our original IVR, and our online website for accepting the credit cards and the ACH, that there was restrictions on who could make payments and who couldn't make payments. I referenced, the customer that was 60 days delinquent before. Well, you want them to call into the office, obviously, because you want to be able to make payment arrangements with them. But while you're on the phone, you also want to be able to make a payment with them. And the way that we were able to accomplish this, while continuing to stay compliant, is this agent-assisted IVR, where our customer service representatives can, along with the client on the telephone, can call this telephone number, and the customer can make and give all of their credit card information and their payment information without our customer service representatives hearing any of it. So we're able to get that customer to make a payment with us on the phone right now, but yet we're still staying compliant and not hearing any of the information or having any of that information in our office, so there's nothing for us to do to stay compliant.
Right.
Which is a great thing. It's totally cost saving, and we're excited.
So we've got another question for you, Amber, as a follow-up to that. Do you find that you lose payments because customers hang up when they're transferred to the IVR?
We haven't done an official study, but the gut feeling is that yes.
Yeah,
there are
some people are going to tell an agent, a live person, that they're going to make a payment, but they're, once they're transferred, they're just not, right?
Exactly. Exactly.
But presumably that person, if they felt coerced into making a payment, they're, maybe they wouldn't have followed through with it anyway, or, maybe the check would have bounced, or who knows what.
Exactly. Exactly.
Yeah. So getting back to the concept of convenience fees, one of the questions that came in, it says, do you believe that customers are fully aware that they are paying a fee to make payments online via a third party? And have you seen any pushback from customers not wanting to make that, that payment? Tyler, maybe you can comment on that.
Yeah, so we actually, about a year and a half ago, we had decided that we wanted to find a way to reduce our convenience fee for our customers, because obviously when we have them on the phone, we really want to encourage them to take care of it then and there. And the higher the convenience fee, the harder it is to get it collected. So yes, we did have pushback from people about the convenience fee. So what happened was we ended up cutting that convenience fee in half, and in the past we had shared in that convenience fee, and in order to get it down, we decided we were no longer going to share. We cut the payment in half, or the fee in half. And yes, absolutely, people are aware, because when they do it online, they do it through the third party's website. When they're on the phone with our agents, they are advised of the fee. And when they do it through the IVR, they're also advised of the fee. And we're also very clear that that fee is directly charged by the processor, and we don't have any participation in it, but that we have made the effort to get that fee as low as possible. And most people don't, of course you still get a few that complain here and there, but for the most part, people are okay with it because they recognize that that fee was reduced even more from where it was.
Okay. Let's see, I am seeing some questions. If you've asked a question, just know that I will try to get to them, and just try to weave them in when they make sense, and if not, we will cover them at the end. So thank you so much for asking questions. So on convenience fees again, maybe Nick, if you go to the next slide, one of the concerns that with regard to this notion of consumers being aware of it is obviously that there have been issues. Definitely in collection agencies, there was a very large enforcement action that resulted in a close to $1 million fine due to the disclosure, or the lack of disclosure, that there was an alternate payment channel available to the consumer. In other words, the consumers were led to believe that they had to pay the fee and that there was no other way to make their payment. And again, this is a way where technology can be your friend in that, by effectively, not accepting any touch tone input on an IVR system until the consumer hears the entire disclosure. making the same true of a website. I'm sure we've all seen where you have to scroll down and say, I accept the terms before you can submit the transaction. So those kinds of things can make it possible for you to ensure that your consumers are aware of the disclosures. But convenience fees bring in an additional wrinkle, and that is that there are a number of state regulations surrounding convenience fees. On this map, the red states are those with credit card surcharge laws. And while the card brands, such as the Visa and MasterCard, do make a distinction between a surcharge and a convenience fee, we've been unable to find any precedents or evidence that state lawmakers and attorneys general are making the same distinction. So how do you handle these laws and the fact that they are kind of becoming more popular? There are a number of states that are considering similar laws right now. Amber, how do you handle that at Security Auto?
If the state doesn't allow it, we don't charge it.
Okay.
And,
so you just keep out of the red states, basically.
We do business in the red states, but if we have customers in the red states making the credit card payments, we don't charge them the convenience fee, and it's stated on the disclosures on our website and our IVR. So it just we'd like to err on the side of being conservative.
Right.
So.
And Tyler, how about you?
We do the same thing. If the state doesn't allow it, we cover it.
Okay. And Nick, what about in the auto finance industry? Have you come across any enforcement actions or lawsuits in this regard?
I don't, at least as far as the convenience fees or that sort of thing, I have not. It's been more of the disclosure of add-on products, that sort of thing that has gotten more attention. But this, as Tyler and Amber have indicated, it seems as if finance companies are abiding by the various state laws.
Right. Okay. All right. Well, maybe we can move on to the next topic, which is payment acceptance, channel adoption, and the consumer market. So there are a couple of kind of detailed slides here. This one, which is regarding the forms of payment that are accepted today. And going back to the discussion about cost reduction, loan servicing and payment acceptance is an obvious area of cost for any finance company, and moving to automated ways to accepting payments is a great way to reduce those costs. At the same time, you offer greater convenience and can capture more payments. One graph that we don't have on the slide deck, but it is in the report, and someone had asked this question, shows that subprime borrowers use credit and debit cards as their overwhelming way to pay, more than the population as a whole, and more than cash, which I think was a little bit of a surprise. At least to me, I was thinking that maybe the subprime borrowers, including underbanked populations that don't have access to traditional forms of credit, bank accounts, debit cards, and so on, might be using cash. But I think they are, but I think they're also using prepaid cards and other types of payments on the market that, from a processing standpoint, show up as a credit or debit card. Is that what you're finding, Tyler, in your acceptance of payments?
Yeah, I mean, our biggest group by far is credit, debit, and then ACH. But I think part of that is that we don't accept anything but credit or debit through our online or our IVR. So the only way that they can do an ACH is if they do it over the phone with an agent, as opposed to actually doing it themselves. But even still, I mean, they're far and away our two biggest next to mail.
Okay. How about you, Amber?
We are actually getting more of the credit and the debit than even the mail lately. They just seem to have blossomed and grown. Something of note that I wanted to mention is that we don't actually accept cash in our office. We're just we have one office, and that's our local customers can come in and make payments. We are in 11 states, but we would prefer, and we do have rules, that customers do not make cash payments in the office, that we do have the other, they can make the credit card payments, they can make the debit card payments online or via the phone. We've got other options, they can call or they can mail in a check, they can, use MoneyGram, Pay Near Me, different options that they don't need to make the cash, but overwhelmingly still, they choose to make credit card payments and debit card payments. So yes, I agree with, that figure.
Right. And looking at the statistics from the auto finance companies that BillingTree services, the amount of debit card usage is overwhelming, and like in the very high 90 percentile, and that includes prepaid cards. We had a little discussion about prepaid cards when we were preparing for this session. Amber was really not thinking about prepaid cards, wasn't really aware that they were there because we really hadn't had any problems with them. But Tyler, you mentioned that your organization had some issues with prepaid cards.
Yeah, we had some issues, and I'm not going to pretend to quite understand how it's all set up. You would know better than I would, but because of the way that they're defined as the merchant, sometimes as we try to process those, we have some prepaid cards that won't go through. And so a lot of times if we get declines, the agent will ask, is it a prepaid card? If so, what kind is it? So that's how I recognize that we definitely get a lot of prepaid cards because people are talking about it.
Right.
I mean, otherwise you would really not have much way to know here on our side because all we're looking for is for it to approve or decline and follow up with the customer.
Okay. Here's a question that we didn't prepare for, and I can help answer it, but maybe Tyler, I'm thinking you might know something about this. It says, does anyone have insight into the Visa or recently revealed MasterCard debt repayment programs?
I haven't heard anything on that one myself.
Okay, so I can just kind of fill in the audience briefly that the Visa debt repayment program was set up because effectively Visa has historically always wanted to make it unfavorable, I'm trying to look for the word, to use a credit card to pay debt. So there are a number of ways that they go about doing that, and one of them is that they have authorized the use of credit to pay debt in specific cases, and that is the Visa debt repayment program allows merchants to accept Visa debit cards for the payments of mortgages, student loans, auto loans, and there's a fourth item, and I can't remember what it is. But that is one of the ways that Visa effectively, gives you the authorization to do that. The reason for that is that, if you think about how Visa and MasterCard operate, they have issuing banks that are the ones that are actually extending the credit using the Visa guidelines, and the issuing banks don't want to be the ones holding the bag. So if someone has a Chase credit card and then they use a Wells Fargo debit card, or excuse me, credit card to pay off the Chase credit card, then it's just transferring the debt over to a different issuer. So Peter and Paul didn't want to have to, get into that conundrum. So that was, I think, the historical reason behind the Visa debt repayment program. But technically, Visa does want to see only debit card usage, which really shouldn't be a problem because, again, in our statistics, we see that in the auto finance market, it's overwhelmingly debit cards, even when credit cards are in there, and credit cards beyond MasterCard and so on. So let's see. If we go to the next slide, you can see that the planned payment acceptance, there's a lot of, again, mobile, online is planned to be accepted here. I think one of the things I want to point out is that between the last slide where we saw online being the largest, one of the largest places to accept at about 74%, if you add that to the online here at 31%, you're basically looking at about 100% online acceptance by the end of 2014. Now, that is definitely a very lofty goal, and maybe every auto finance company won't have an online payment capability by the end of this year, but it's certainly something that is worthy of consideration, given that you can use it, a lot of benefits for online payments in compliance, security, Regulation E for recurring payments, and so on. But let's talk about the growth of mobile. According to a 2013 TNS financial survey, nearly 60% of millennials, or those people between 18 and 33 years old, consider themselves early adopters of technology, and nearly 2/3 express a strong preference for mobile banking. And according to the FDIC's 2011 survey of unbanked and underbanked consumers, who are largely low-income immigrants and so on, underbanked consumers' use of mobile technology has outpaced the market as a whole. So 91% of unbanked consumers have a mobile phone, and with 57% with a smartphone, compared to only 87% and 44% of consumers as a whole. So what do you think about that? Have you had specific strategies around mobile or reaching your underbanked or millennial populations? Maybe Tyler, we'll start with you.
That's something that we've talked about and one of the things we want to look at moving into. We haven't actually done it yet, but it's something that's high on our list of wants in terms of going forward on payment acceptance. Because we recognize that there are, look, we all carry our phones everywhere, and it's easy, it's convenient, and whatever we can do to make it more convenient for our customers to make payments, we definitely want to do that.
Okay. And Amber, what about you? Are you thinking about how to reach that population in any particular way?
I don't think we've done anything more than just set up, the IVR, as I mentioned before, and the online website. I mean, if you can get the internet on your smartphone, you can make a payment to security auto loans.
Right. So there are a number of mobile applications that are possible, and these would offer additional services like loyalty programs or offers or payment reminders. One of the questions that was asked earlier in the webinar had to do with express consent. So let me find that question. It says, how do you, from a process perspective, handling the TCPA regulation of obtaining express consent? Through written or email or website channels? Is that a way that you are doing that? And maybe this just has to do with calling your consumers.
If it's in regards to collections, unfortunately, I am not the most well-versed in that department, so maybe Tyler can help a little bit more.
Yeah, I can. The way that we do ours is through a disclosure with our credit application. So either with an application or addendum, as well as many of the contracts. A lot of the retail installment sales contracts these days get the express consent that say that we may contact you via email, phone, or text that you provide to us. So that's how we go about doing the express consent part. And we also have opt-out options as well, for automated programs, so that they can opt out if they choose to do so.
Okay. And actually, so maybe that would move us into the next section to talk a little bit. We've got about 10 minutes left about the communications with borrowers. And when we think about this, we think about it as the life cycle of communications, starting with prior to the purchase of the vehicle, and and ending with just prior to the purchase of the next vehicle. On that note, I'm going to launch a little poll to try to get a sense from the audience of what, hold on, I'm trying to figure out how to do this here. shoot, this one's not on here. I'm sorry, I don't have this poll on. The question I was going to ask was whether the audience was concerned about repeat business. Is that something that you consider to be a core part of your marketing strategy? Maybe Tyler and Amber, you can just speak about that in terms of your business. Do you try to actively market to your audience?
We are an indirect lender, so we actually market to dealers, not to consumers.
Okay.
So this doesn't really apply to us.
And
You're the same. So
yeah.
How about just sending out communications in terms of balances and things like that? Do you do that via paper or email?
Our customers actually, when we enter their loan contracts, they were originally sent a payment book, and then recently we have moved to sending them a credit or like a little business card with the information about their payment and their account number, so that when they do make a payment, they've got that. We don't give them any mailings in regards to balances unless it's a collection letter. And again, I know that one of the, I can't speak intelligently enough in regards to it, but I know that we do send letters, but we are very, 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 very careful to remain compliant with those letters and stick with what's sent. And we don't do invoices or any kind of that type of thing anymore. It's expensive to mail, so, and texting we're hesitant to get into because of the whole, we need proper approval from the customer, and that's been, legally we haven't been able to find anything that says, okay, this is okay for you to do provided that you have this from the customer.
Right. Tyler, where do you guys stand on that in terms of, texting in particular?
We're very similar in terms of what we send out. We also send coupon books. We don't send statements, though we have explored the idea of whether we want to make that switch or not. But in terms of texting, like I mentioned, we do get in our addendums and our disclosures that we will be able to text. And so we do text communication, but again, we also offer opt-outs, and if someone opts out, we're very careful to make sure that we get them opted out so that they're not receiving text messages.
Right. What do you think about it? One of the things that we've seen at the captive end of the market, in addition to this need to communicate and effectively use the opportunity of loan servicing to try to encourage the customers to buy another vehicle of the same manufacturer, is the concept of having like a loyalty program. I believe that Subaru, for example, offers a mobile application that has a loyalty program for making the payment via the mobile application. What do you think that any of that would translate to the subprime market in terms of, do you think that a subprime borrower would be willing to download a mobile application onto their phone, or do you think that they would have a reluctance or fear that that was somehow related to a GPS type device?
I can honestly say I'd never really thought about it.
Do you use GPS devices, Amber?
We actually do use GPS devices. The customer is aware that it's put on. They have to sign an agreement with it. So I guess just off the top of my head, I would say I wouldn't think that people would consider it. I guess if I'm downloading an app, I don't think about whether they're going to use it to track me.
Yeah.
And maybe I'm kind of simple and naive in that aspect, but I can't imagine that if it's something that's going to help the customers in the long run, that they would really consider the GPS aspect of it or tracking.
Right. Do you think if you offered your borrowers some sort of loyalty program, points toward merchandise or dollars off their loan or something like that, do you think that that would encourage them to make their payments on time, for example?
I'm sure it probably would. We just have never even thought of it before.
Okay. Tyler, how about you? Do you have any ideas about that?
You know, I think that it definitely, people would jump onto that. You know, there are companies out there that offer different rate reduction programs, and they have certain stipulations that have to be met for that to happen. And I think that we're moving into a time where, you know, the easier it can get, the better. And so I think really any customer, subprime or not, if you can get them a mobile app that allows them to do the things that they want to do, to see their account, to make their payments, to communicate, it's a win-win for both them and for the company.
Right. No, I would agree. I mean, I tend to see it in the context of, you know, there are plenty of studies that have shown that people are shopping for their car online. They're only visiting effectively one dealership. I think it's like 1.4 dealerships on average, where they used to visit 5 dealerships before making a purchase, because all of the shopping experience and the research has moved online. So to me, it seems like a natural extension that you would engage the customer through the life cycle, which is why we call it a life cycle communication, you know, until their next purchase of their next vehicle, because presumably they're always going to be rolling from one vehicle to the next. There was a question here, I think, that I would direct toward you, Tyler. It says, are text messages used primarily for confirmation and follow-ups rather than confidential or sensitive information?
For sure, yeah. I mean, it's mostly for, you know, reminders or, like you said, follow-ups. We try not to do the sensitive information with text messages.
Okay. I'm just trying to make sure we have all of the questions answered. I think we are at the end of our hour, but I really appreciate all the participation from the audience, and absolutely from Tyler and Amber and Nick. Nick, do you have any closing remarks or anything that you think we should have covered more of?
A point I forgot to mention at the top of our session here is we are recording today's webinar, and keep watch of your inbox for a message containing a link to the recorded session, so you could review any of the great points that have been shared, or share the recording with other members of your organization. So keep watch of that. That'll be coming as quickly as possible.
And let me mention, too, that we at BillingTree, we always do a follow-up poll after every webinar. We definitely want to hear your feedback. If you enjoyed today's webinar, if there's ways that you think that that we could have improved. I don't think that Amber or Nick or Tyler could have done anything differently. I think you guys were great. Thank you so much. And I appreciate that one of our audience members said that they would like to be on our next panel. So I will look forward to that. And maybe we will, you know, do more as a follow-up and get further respondents to this survey. But please do, when we close the GoToWebinar session, you will be automatically sent to a poll just to get your feedback on the webinar itself. So please, we ask you to give us your feedback, because we do appreciate it. And we do appreciate you attending today. And thank you again to our panelists. Have a great day.
Thank you again, everyone.
Thanks, Maria.
Thank you. Bye-bye.
Bye-bye.